borrowing cost. This in turn has supported banks' lending capacity and allowed access to credit for households and firms. While uncertainty on the duration of the pandemic had led to slowdown in bank lending in the first half of 2021, the demand for credit by firms and households has been improving recently, as shown by 5 consecutive months of positive growth in outstanding loans. The reduction of fees for online payment transactions, together with restrictions arising from the pandemic, accelerated the usage of digital financial services. With the provisional advances by the central bank to the national government, it was able to pursue its COVID-related programs. It allowed for budget financing flexibility to the national government, but more importantly, avoided the risk of market volatility. The economy is now recovering. After 5 quarters of economic contractions, the country's real GDP started to grow in the second quarter of 2021 with 12% growth. Since then, the country has managed to post positive growth rates despite a number of re-implementation of stricter quarantine measures. The latest was at 7.7% in Q4 of 2021. That resulted in a full-year growth of 5.6%. The government projects that the Philippine economy will grow by 7 to 9% in 2022 and by 6 to 7% in 2023 and 2024. Employment is also on the rise. In December 2021, the country has continued recovering some of the employment losses during the pandemic. Employment level reached 46.3 million, or a 3.7 million net employment gain compared to the pre-pandemic period. The resulting average unemployment rate for 2021 at 7.9% is within the 7 to 9% full-year target of the government. The country's inflation is manageable and within the government's target range of 2 to 4%. The country's headline inflation slowed down to 3% year-on-year in January 2022, from 3.7% in January 2021. This was mostly driven by slower price increases of selected non-food items, along with alcoholic beverages and tobacco. Private sector economists expect inflation to average 3.5% in 2022, while the mean inflation forecast for 2023 stood at 3.1%. Inflation projections by multilaterals and market analysts for 2022 and 2023 are within our inflation target of 2 to 4%. As we move the economy forward into full recovery from the pandemic, we must also plan to establish normalcy in the conduct of monetary operations. From previous crises, we see that central banks follow a typical sequence for unwinding their interventions. The usual strategy has been to first withdraw any extraordinary measures that exert downward pressure on interest rates before raising the main policy interest rate. In this slide, we show the elements and possible broad sequence of the central bank's exit strategy. The first component involves the recalibration of the BSP's monetary operations, which helps to ensure that our accommodative monetary policy stance is transmitted to the economy through short-term interest rates. Another component involves the unwinding of the measures that infuse liquidity directly into the economy, such as the provisional advances to the national government and the alternative compliance with reserve requirements. The third component entails the reduction in monetary accommodation, or the eventual raising of the policy interest rate when prospects for the economy have materially improved. And finally, our exit strategy also involves building on our buffers to ensure that the economy is prepared and resilient in the event that another crisis strikes. We would also like to emphasize that the timing of the exit remains very uncertain at this point, while recent indicators point to a significant recovery of the economy, the threat of further COVID-19 infections continue to pose a downside risk to both growth and inflation in the coming months. Therefore, we deem it prudent to leave some room for flexibility in policymaking to account for uncertainty and risk, especially as the situation remains fluid. The BSP's tapering has already started. The advances to the national government decreased from 540 billion pesos, or about 10.5 billion US dollars, in July 2021 to 300 billion pesos, or $5.8 billion in January 2022, and to zero by Q3 2022. Our purchases in the secondary market has gone down from 19.4% of total government securities portfolio in 2020, year one, 4.8% in 2021, year two, to 0.7% from January to February this year. On the fiscal side, the present administration is crafting a medium-term fiscal consolidation program, which will be turned over to the next administration. The main goal is to progressively cut the deficit to GDP ratio over time. On the monetary side, continuity is assured with my term ending in July 2023. There are two things going for the Philippines. First is the continued confidence in the Philippine economy amid the challenges caused by the pandemic. The country continues to have a favorable medium-term growth prospects based on the stable outlook affirmed by a majority of major credit rating agencies. Fitch Ratings affirmed on 18 February the Philippines credit rating of BBB, a notch above minimum investment grade, citing economic gains that demonstrate sustained recovery from the COVID-19 crisis. The country has maintained the same rating from Fitch as with the ratings of other debt watchers throughout the pandemic, despite a wave of rating downgrades for many other countries during the same period. Second, we didn't sit idly by during the pandemic and watch the virus to recede. We pursued game-changing structural reforms. The Retail Trade Liberalization Act, which lowered the minimum paid-up capital for foreign retailers. Second, the amendment to the 80-year-old Public Service Act, which will open up key economic sectors, including telecommunications and airline industries. And thirdly, the amendments to the Foreign Investment Act, which will encourage foreign professionals to bring their practice, know-how, and technical expertise to the Philippines. Fortunately, all three measures are nearing the finish line. Meantime, the BSP is pushing for amendments to the implementing rules and regulations of the Agri-Agra Credit Act of 2009, which allows banks to lend more types of farming communities and classify more loans as compliant with the law's quotas. This could strengthen rural development by providing a holistic approach in addressing the financing needs of the broader agricultural ecosystem. We expect Congress to pass this soon. I'm confident that with these game-changing reforms, we can achieve real change in the lives of ordinary Filipinos through more and better jobs and more competitive economy. Now, similar to our initial responses to the pandemic, the sustained growth of the economy would require a whole-of-government approach. For now, sustained monetary policy support should help the economic recovery gain more traction. On the part of fiscal authorities, the continued implementation of targeted fiscal initiatives and commitment to continue exercising fiscal responsibility should support market confidence and safeguard the economy's momentum. The BSP affirms its support to the economy for as long as necessary to ensure the country's strong and sustainable recovery. I'll stop here. Thank you.
Thank you, Governor Diokno. Excellent, very crisp presentation. Very great, ideas that you presented. One or two things that I took away is the fact that Philippines inflation is actually relatively quite modest compared to some of the peers in the developing. So that is quite remarkable. We said about 3% and so on. And then the other main thing I picked up was the coordination between monetary and fiscal authorities, which also is perhaps quite innovative and unconventional. And, as you in the last slide also mentioned that it is still a situation perhaps is not fully robust. Maybe there is some fragility, so we need to be watchful. But we'll come back to you with some questions, sir. We will move to Governor Ajith Cabral of Sri Lanka for his initial remarks. Over to you, Mr. Cabral. You have to be... yeah, thank you.
Thank you. Can you hear me?
Yeah, yes.
Yes. Thank you very much. And thank you very much for inviting me for the Economic Policy for Sustained Post-Pandemic Growth symposium that you have organized. Let me congratulate the authorities for doing so, because I think it's very helpful for us to look at the lessons that we have learned, because those will probably help us to face something else that happens in the world, and we see so many different things happening all the time. So thank you for organizing this. And the role of the central banks in particular in that context is also very welcome, because when Governor Diokno was speaking, I did realize that although there was no discussion of sorts between the governors, the number of areas where there seems to have been a sort of a planned approach as well, because some of those that the Philippines had executed were areas that we have also given attention to, and we have also done, because I think those were natural responses. In addition, I must say it is commendable that the Philippines have done a few areas more than what others have done, particularly in the field of ensuring poverty reduction, as well as ensuring that your growth levels are sustained. And also how you have contained inflation is exemplary, and I want to also congratulate Governor Diokno on that. Let me share a few thoughts about the key principles on which we have also worked out during the course of the pandemic. I must admit the brunt of the pandemic reactions were taken over by my predecessor, Governor Lakshman, and I succeeded him in September 2021. But this was my second stint as the governor after having been the governor for a long time before. So coming back to the field, I did realize what a huge challenge my predecessor has faced, and I was at the tail end of that. But nevertheless, I think we are now in the throes of new challenges, and that's also very interesting for us to discuss so that we can see how best are we going to deal with that. The first point was similar to what Governor Diokno mentioned, is about the stimulating the economy. In times of difficulties, in times of crisis, in times of uncertainty, I think central banks need to stimulate so that we ensure that the robustness of the economy is retained. And pretty much like what the Philippines had done, Sri Lanka also had to do and did. Stimulation of the economy came in the form of supporting the government with liquidity. And that was also to ensure that there is market liquidity. And both those were extremely helpful in ensuring that the market as well as the economy would be on a momentum of sorts. I know it was never going to be of a very high standard, but still it was very, very helpful. Confidence was very helpful to achieve. And stimulating the economy allowed central banks to play a very key role in maintaining the confidence of an economy. And that's something I believe was very important, and that was done. The other was the support to the vaccination program. Many central banks, I think, supported it, and we were also instrumental in doing so to ensure that the country's large number of people, as many as possible, were vaccinated, and that was a big challenge, and we all supported that. The other was, I think, dealing with the lockdowns. Initially, we all had a feeling that lockdowns would ensure that the virus spread could be contained, and to some extent it did. But whilst lives were saved, livelihoods were affected very, very badly. And I think that's one of the lessons that we will probably learn, and we'll have to deal with that situation in the future as well. Livelihoods are so important that if livelihoods are not taken into consideration for the equation, that it can do as much damage as lives being lost as well. I think that's something that we experienced at the initial stages of the lockdown. Many people were affected very, very badly. And to deal with that, the moratoriums that were brought in were helpful. Sri Lanka had moratoriums which provided support to about 40% of the total lending. And that was enormous support. And the most moratoriums are going to be unwound by 31st of March 2022. And that's after 2 years. So for 2 years, we've had to deal with the moratoriums. And now we are working out schemes as to how the moratorium could have a soft landing. And that's also as important. What would be the way in which the people who have had a relief for such a long period of time, what would be the way that they would be nursed back in their businesses to meet with the challenge of repayment, whilst the economy was on the recovery takeoff position as well. So that's another interesting balance for us to manage. We have gathered a vast amount of data on this subject, and we are about to introduce the moratorium relief package that would help the soft landing of all the people who have been affected and who now need to start repaying. And that, mind you, has to be done without undue burdens being cast upon the banks and the financial institutions, as well as having a balance of the businesses as well. And that's an interesting balance, and we would be very conscious of the fact that that would be something that we'll have to nurture back. The other matter that we have to always remember is that at some stage, the stability has to be maintained always, but some stage we have to get back to growth as well. And Governor Diokno enunciated that very well. Sri Lanka also had a sharp downturn in the second quarter of 2020, which was about 18% drop in our growth, a negative growth. Then thereafter, from the third to fourth quarters of 2020, there was an uptick. Once again, in the first quarter of 2021, there was a downturn. So it was a bit of a roller coaster ride. But nevertheless, I think we finished 2020 with a negative growth of 3.6%, but we'll probably have about a 4% growth in 2021. And we are now looking at seeing as to how we could achieve the 5% growth that we have set ourselves as the target to be achieved in 2022. Now, in so doing, we have several challenges that we have to meet. One is the challenge of inflation. We are not as fortunate as Governor Diokno. We have seen some of the important inflation coming into our system as well, and that is posing quite a bit of challenge. And that, mind you, is now a question of as to how to deal with this whole situation. The inflation expectations. We are seeing inflation rising, but we see a major component of that not being internally driven, not being demand driven, but driven by outside factors. So that inflation expectations to be managed is also an important part. And the next big challenge is the rollback of the expansionist policies, the liquidity support. We have again started off on a fairly stringent program of gently ensuring that the excesses that have been put into the system in order to stimulate are pulled back without making the market get too unduly complicated or into any difficulty. The next point I would like to talk about is international support. I believe very sincerely that the support that came from international quarters was too little and too late. Many countries suffered from ratings downgrades, and they were having serious liquidity constraints in the initial stages of the pandemic, because IMF also acted quite late. IMF did realize that there was a problem as early as March or April 2020, but they reacted only in August 2021. It was a long time later. During that period, the imperfections as well as the vulnerabilities grew in almost all these economies. Had they addressed it early, it is very clear that some of the difficulties that got festered within economies could have been contained to a great extent. But anyway, better late than never, they say. We did see the IMF package, the additional allocations coming in. That did help, no doubt. But I believe that when it came too late, it also served to fuel some inflation, in my view. So that's something that we should think through in the future as to the timing of any particular type of support that is being given on a global scale. If it comes too late at the time of recovery, it can lead to additional inflation. And to some extent, I believe the current situation of high rates of inflation being suffered by many countries across the world is as a result of that situation. But I did see a silver lining of regional cooperation. Particularly Sri Lanka, we saw regionally many countries standing up, particularly from India as well as China. There were several countries that came forward to be of support to emerging nations. And that's something I believe was a very interesting development that emanated immediately after the pandemic. So that's a sign where we do recognize that countries can come together and deal with issues on a collective basis. And I believe that's a very helpful sign as well. The final part of what I would like to tell you, governors as well as chairman, is to share with you a few lessons that I believe are helpful in going forward and in dealing with this kind of situation for the future. First, I think it's important that we have quick policy implementation. The time lag between a policy formulation and policy implementation should be narrowed down as much as possible in times of crisis. And that was seen in many economies, and I think that's something that we need to document carefully and to have as a support for our future reactions as well as interventions, that in times of crisis, that should be done. The second, I think if you're err on the side of more than less. Sometimes policy stimuli, policy support can be moderate or can be somewhat excessive. But I think one of the lessons that we learned was, if you need to err, don't err on the side of less, but err on the side of more. If it's more, you can always pull back, but if it's too little, it may be wasted. So I think we did see that happening in various policy interventions that we did also. Wherever it was a little more, it did. We felt that the reactions were a lot better, and if we do find that we need to pull it back, we could pull it back as well. The third is we should have several policy options. If we have several, some will work, some won't. We were in uncharted territory. When you are in uncharted territory, sometimes you don't know exactly which way to steer and what needs to be done. So when you are in that kind of a situation, I think central banks also took the position that we need to do certain things, and some actually did not work as well. And those, maybe we can, during the course of the discussions, we can see how best we are going to deal with that. But some worked. So if you have several, there is always a chance that at least some will work, and that would be best as far as everyone is concerned. The fourth is we need to have a lot of coordination between fiscal as well as the monetary authorities, and that's an important one. Think out of the box, and I think when you are having stimuli, think of the winding down as well at the time that you're initiating it. So I think I took a little more time than I should have, Chairman. Please forgive me for that, but I think this was helpful to set the grounds for our future discussions as well. Thank you very much.
Thank you, Governor Cabral. Thank you very much. In fact, I must mention that while we have 3 central bank governors or deputy governor, there are a few important differences. So allow me 1 minute. I couldn't help but notice, Governor Cabral, that some of the issues that you flagged were slightly different. For example, in Governor Diokno, I noticed that the inflation was fairly modest as compared to other countries, whereas Sri Lanka, the challenges of higher inflation. And you did point out that the source of that inflation is actually external. Much of it is external. To some extent, I think it may be the case with India, but I don't want to anticipate what Governor Patra is going to say. But I also I can't hesitate, I can't resist but comment that each of you three have fairly different backgrounds. I think Governor Diokno has been, he's also a professor, so he's very professorial, and he's also, I think, he's written textbooks as well. Whereas Governor Cabral has actually served in the parliament. He's been a member of parliament. And as he himself said, this is his second innings. I think probably very few people in the world, very few governors in the world have come back for a second innings, and that too with a considerable. But I must also mention that Governor Cabral is also an author. And as far as Mr. Patra is concerned, I won't say much because I'll be revealing too much, but I would like to mention that he's an avid sports person also, and a very good cricketer. So over to you, Mr. Patra, for your brief remarks, and then we'll come back to the conversation.
Thank you, Mr. Chairman, and thank you for your very kind remarks. Thank you for having me on this very distinguished panel. Listening to Governor Diokno on the Philippine experience and to Governor Cabral on the Sri Lankan experience has been extremely educative. I have to mention that I have seen Governor Cabral at work in his first innings, and I have seen him transform Sri Lanka into a modern middle-income emerging economy. I think at that time, Sri Lanka issued its first Eurobond, sovereign bond issue, under his watch. Among central banks, you will find a considerable amount of cross-fertilization and learning from each other's experience. So when I speak on the Indian experience, I might be faulted for sounding extremely familiar to what you've just heard, but please bear with me. So let me start with a few remarks on what measures that were taken by India during the pandemic and how we evaluate them today. So the declaration of COVID-19 as a pandemic by the World Health Organization on March 10th, 2020, was followed by a nationwide lockdown in India on March 24. Arguably, it was the strictest in the world, but paradoxically, it set off one of the biggest human migrations in human history. People fled cities to villages in fear of what they at that time thought was an urban disease, only to find that the virus pursued them into the hinterland. Financial markets in India went into seizure. Extreme risk aversion gripped financial institutions, and liquidity dried up. Financial distress spread to small and medium businesses, households, and even individuals who were afflicted by the pandemic. So a health crisis rapidly morphed into a financial and macroeconomic crisis. Before the onset of the pandemic, monetary policy was already in accommodative mode, having reduced the policy rate by a cumulative 135 basis points up until February 2020. Massive amounts of liquidity injections had been made, so much that the RBI was receiving deposits of equivalent to nearly $42 billion on a daily basis, just ahead of the pandemic. As the first wave of the pandemic intensified, the Monetary Policy Committee met in an advanced off-cycle meeting on March 27th. I quote the committee: "The need of the hour is to do whatever is necessary to shield the domestic economy from the pandemic." So in quick succession, the policy rate was reduced by about 115 basis points. That took the cumulative reduction to a 250 basis points reduction. The floor of the interest rate corridor was reduced by 155 basis points, rendering the corridor asymmetric. In effect, the corridor itself was used as an instrument. Overnight rates and soon other money and bond rates converged to the floor of the corridor under the weight of the liquidity which we put into the system. And the floor became the corridor, the floor became the effective policy rate. This floor system, as opposed to a corridor channel system, was actually in operation in many countries in the world during the pandemic. Regular liquidity operations were bolstered by cut in the cash reserve ratio requirement, long-term repo operations, both system level and targeted to specific sectors, institutions, and instruments. Special liquidity facilities were made available to mutual funds and primary dealers, which in hindsight averted panic in equity and bond markets. When high risk aversion among banks impeded the flow of central bank liquidity to the distressed entities and sectors, the RBI put in place a panoply of lines of credit to long-term refinancing institutions, to on-lend to rural credit institutions, MSMEs, microfinance, small finance banks, non-bank financial companies, and housing finance companies. Special windows were opened for health services and contact-intensive services, and banks were told that if they didn't want to use central bank liquidity because they were flush with liquidity themselves, they could use their own liquidity but avail of incentives from the RBI. Asset purchase programs were put in place to undertake large acquisitions of government bonds so as to keep yields low. The result has been that cumulatively, liquidity support of the order of 8.7% of GDP was offered and 5.9% was utilized. Financial markets unfroze quickly and began functioning under pandemic protocols and restricted market hours. Financial institutions remained operational and in good health. Illiquidity risks ebbed as the lifeblood of finance started to flow to various sectors, especially the disadvantaged and badly hit. Market panic, bank runs, and disorderly market movements were avoided while confidence was shored up. Our liquidity operations ensured the lowest borrowing costs in decades and brought about compression of spreads across rating categories. This, in fact, allowed the government to borrow at low cost to fund a fiscal stimulus of 11.4% of GDP delivered over 2 years. Corporations replaced high-cost debt, reduced leverage, and built up retained earnings as sales slowly started to pick up after the first wave lows. For banks and financial institutions, liquidity operations, regulatory forbearance, and recovery operations kept non-performing assets low, preemptive provisioning high, and enabled a return to profitability. There was very close and continuous coordination between the government and the RBI throughout this pandemic response. The RBI not only suggested, but was also consulted on several fiscal measures. The timings of our announcements were adjusted to derive the maximum announcement effects. In several windows that RBI provided liquidity, the operations of the RBI were complemented by guarantees offered by the government for collateral-free loans to various small entities which were affected by the pandemic. The government also provided interest rate subventions which lowered debt servicing costs. On its part, the RBI, as the issuer of the government's debt, ensured the smooth passage of the government's borrowing program, both of national and subnational governments, while elongating the maturity of public debt. On the path that monetary policy will take going into the future, I thought I would situate my remarks in a global context because I think India will take a path which will be different from the rest of the world. In fact, as the pandemic continues to shape the global outlook, macroeconomic profiles are differing widely across the world, depending on, in my view, on two main factors: the size and staying power of monetary and fiscal stimuli, and access to vaccines. Consequently, monetary policy, which has a predominantly domestic orientation, is taking very, very different roads across jurisdictions. In the polarized debate that is going on worldwide between team transitory and team permanent on inflation, team transitory seems to be getting bulldozed into a minority and pushed into a corner. Meanwhile, as increasing number of central banks tighten monetary policy or indicate intent to normalize, financial conditions are hardening globally and markets are turning increasingly volatile. To my mind, this is the biggest risk to the global recovery and may even tip it into a premature recession. Let me elaborate this further because I know I'm making slightly different remarks than what you've heard in the narrative today. On global inflation, my view is that we are paying the price of bounding too quickly out of the pandemic's downturn. The overall policy response to the pandemic has found it easier to revive revenge spending than to bring supply capacities on stream. Consequently, even a weak uptick in demand is appearing excessive in the face of supply constraints. The pandemic has also caused supply capacities to be in the wrong places. Illustratively, there has been a surge in the demand for manufactured goods, but an evaporation of demand for contact-intensive services. The result is supply snarls in goods and excess capacity in services. Monetary policy as an instrument of stabilization works by adjusting demand to the level of supply, not the other way around. Consequently, efforts to address immediate inflation pressures that we are seeing today all over the world and caused by supply bottlenecks that keep aggregate supply below recovering demand may not work. Given the lags with which monetary policy operates, today's actions can at best be expected to impact inflation 6 to 12 months down the line. So what will be the character of inflation 6 to 12 months ahead? Any projection available today shows inflation peaking in the middle of 2022 and easing thereafter. The OECD estimates that half of global inflation is due to supply chain disruptions, port congestion, shipping charges, and shortage of key intermediates like semiconductors and chips. The New York Fed's global supply chain pressures index is peaking and is set to moderate from here on. Moreover, it is important to be cognizant of what is called the bullwhip effect. As demand gets stronger, finished goods inventories which are piled up with wholesalers and retailers will be released into the market. And along with the easing of supply chain problems, there will be a supply glut. New orders will not go up at that time and activity will slow. At that time, today's monetary policy measures may bite, but they will not impact inflation, which is set to ease anyway by the second half of 2022. Instead, they will kill the recovery. India's inflation dynamics are different from the rest of the world. Early during the onset of the pandemic, India got a bout of high and persistent food inflation. Just to keep this perspective, close to 48% of our CPI is food. But determined supply side responses to augment the supply of inflation-sensitive commodities, including long-term contracts for imports for pulses and oilseeds, drastically reduced tariffs and incentives to boost productivity, broke the back of this price surge and tamed inflation. Cuts in excise duties on petroleum products are still working their way through the economy and keeping these pressures subdued. In the case of India, wage growth and house rentals, the second order effects that plague the inflation spiral, have not yet bugged. Firms are exhibiting low pricing power due to substantial slack in the economy and are not passing on input costs to selling prices. Consequently, the level of inflation in India, which is measured on a year-on-year basis, is appearing elevated, but that is purely due to statistical base effects. The momentum or month-to-month changes in inflation are negative and pulling down inflation. Our sense is that headline inflation has peaked in January, and from here on, it will ease down to the target of 4% by the last quarter of 2022. And this has provided us the space to maintain policy rates low and persevere with an accommodative stance so that we can focus all energies on